Hello, this is a video for IME 315, Financial Decision Making for Engineers at Cal Poly San Luis Obispo. My name is Liz Schlemer. This video covers taxes, and this isn't the first time we've talked about taxes, but this is in relationship to the calculation of cash flows. So when we look at the 5 topics that are covered in this class, this video covers both investment analysis and reporting and managing profits. So when I look at taxes, it's always equal to some kind of taxable income times a tax rate. And that is just how taxes are calculated. When you look at corporate taxes, the taxable income is equal to revenue minus expenses. And those expenses can include non-tax write-offs like depreciation, like we've talked before, but it's always just the net of revenue minus expenses. In personal taxes, it's the wages you earn minus the deductions you get. And for most people, the deduction you're going to get is a standard deduction per person. So if you're one person, you just get one standard deduction. If you're married, you get 2. If you have dependents like children, then you get more standard deductions. And the other way you can do it is itemize. So you might itemize if your itemization is larger than your standard deduction. And itemizations are things like charitable contributions and interest expense on your home. So if you have just bought a home and it's pretty expensive, that interest expense could be quite large. And the same as if you regularly give to charities, you would then itemize. What we're talking about today, though, is corporate taxes. So when we look at federal taxes, there's kind of 2 different ways of doing it. One is progressive tax, where each additional dollar is not each, but at points in time, the more you make, the more marginal tax rate you have. And that's as opposed to a flat rate tax, where the tax rate is the same no matter what. Personal taxes are taxed on a progressive system like we talked about before, but corporate taxes are based on a flat rate of 21%. That's the federal portion. Now we need to also include the state portion, and in California, the tax rate is 8.84% for a flat tax on state corporate taxes. So in order to figure out what the combined rate is, we use this equation. And the reason we use this equation and not just add them together is that state taxes are deductible for federal tax purposes. So that's why we subtract 1 minus S, multiply by 1 minus S times the federal rate. So if we have the total tax rates T, the federal rate is F, which is 21%. The state rate is 8.84%. And so when we do that calculation, the tax rate we get is approximately 28%. And that's the value we're just going to use whenever we do the calculation on taxes. And we'll calculate the taxable income and apply a 28% rate for the tax calculation. Now there's another kind of taxes that's not just general income tax, but it's called capital gains tax. And this occurs when you sell an asset you've had for a long time, and you have to pay taxes on what's called the gain in value. So if you bought a business and then over time it increased in value, you have to pay on that gain. Now we assume these gains are taxed at a normal income tax rate. That's generally what it is. Sometimes it fluctuates depending on the tax code. The rates might be different, but we're going to use the 28% for capital gains rate. And the gain is equal to the selling price. So the amount that you're selling, in the case of the example I used before, the business for, less the book value. So the book value, if you remember when we talked about depreciation, we calculated a book value, which is the purchase price minus all the depreciation to date. So it's what's called the undepreciated amount. That's what we use to calculate gain. So let's say we sell a business for $100,000 and on the books it has a value of $75,000. We're taxed on the $25,000 gain. So another thing you need to remember is the negative taxes. The IRS never gives you money back, and I talked about this in the depreciation calculation. Sorry about that siren. But if a project is part of a larger enterprise, losses can be offset by gains in other parts of the company. So we just assume it's totally okay to just do the straight calculation for negative taxes. And then the other thing is if there's not gains in other parts of the company, you can use loss carry forwards or loss carry backs, which means that you can offset future taxes or past taxes by negative taxes. So the bottom line is it's okay to do the calculation when you're doing taxes to include a negative tax value. Now, this particular video covered taxes, which falls under the category of investment analysis and reporting and managing profits.